Okay, welcome. My name is Gavin. Welcome to Alphachain's weekly markets analysis. It is the 22nd of August, and we're starting a fresh new trading week. And what we're going to do is we're going to cover what has happened last week, what to expect for the week ahead, and maybe give you some trade ideas that you can look to develop for the trading week. So what I'll do is let me bring up the economic calendar. As usual, we'll start here. Let's focus on last week's trading session. What can we take away from last week's trading session? So if I just go last week. Right, I mean, last week started off quiet. There was mostly low impact news. There were a couple of bank holidays in the Euro area. It was Tuesday where some of the high impact news began. Started off with meeting minutes from the Reserve Bank of Australia. So that gave us an insight to their last meeting. Again, it wasn't a market moving event. Leading into the rest of the trading session on the 16th, Tuesday the 16th, we had CPI. So CPI for Canada. And that came in at, on a month-to-month, came in line with the forecast of 0.1%. So the common CPI year-over-year figures up by 5.5%. So certainly sort of hotter than anticipated, looking at the sort of the big picture view. But again, moving on to Wednesday, this is where we have another very important data points here. So firstly, and Wednesday was the most important day of the trading week last week. We had overnight the RBNZ with their rate decision. Okay, so they did raise rates by 50 basis points. So they've gone from 2.5% up to 3%. It was pretty much in line with expectations. And the statement and the commentary was similar to how we anticipated them to view their economic data points. So yeah, it was pretty much in line with what the markets expected. And then 7 a.m. UK time, we had for the UK CPI figure. Okay, now this CPI figure was an important one because this was indicating the market forecast as somewhere between 9.8 to 10%. That was what was being sort of guided by a lot of economists. And it came in slightly higher, came in at 10.1%. And now this is the first time that the UK is gone into double-digit inflation levels, marking 4-decade highs. Okay, so 4-decade highs in their inflation report. And this has also put a lot of pressure, one, in regards to the Bank of England, in regards to their rate guidance going forward. They are certainly behind the curve. They have only taken small incremental steps. They didn't ramp up as aggressively as some of the other central banks. And that's why we still have inflation elevating at the same time, while we have the central bank raising rates from their last rate rise was at 50 basis points. We're now expecting another 50 basis point rate rise in the next meeting. But in addition to that, you have other factors that are also looming and having an impact in the markets. It starts off with, as you can imagine, energy prices having a significant impact. And that's also leading into the cost of living crisis, and then some political uncertainty in regards to who is likely to come into power come September the 5th. It is looking like Liz Truss will be the most likely of the two based on pollings. But some of the rhetoric coming from Liz Truss hasn't been in line with what we'd expect for the next PM to the steps that she will take when she comes into power. Firstly, she's mentioned that she's going to question the Bank of England's independency. Okay, so there is some discussions taking place around whether the Bank of England should be independent. The second point is she's looking to have the three important UK regulators be merged together in some way. And so, you know, there's big changes expected by Liz Truss already in her candidacy to become the next PM. So yeah, that's only going to cause certain more uncertainty in regards to what can the Bank of England do, and it does put Andrew Bailey, the chairman, the governor, under a lot of fire at this current moment, especially from a political standpoint. So yeah, that was the most anticipated of last week's data points, especially when inflation is one of the key catalysts driving market conditions. And then moving over to the US session, in the US session, we had retail sales. Now, core retail sales came in much better than anticipated, coming in at 0.4%. But do note, we did have some speeches. We did have some speeches coming through. I might touch on that in a little while, but all eyes did fall onto the FOMC meeting minutes. So this is from the last rate decision in the blackout meeting that they had. These FOMC members, what were their views, right? So that's where we get a detailed report in regards to what took place in that meeting prior to the last rate decision. So again, it didn't stand out too much. I think the market's already priced in most of that information. I think that what they're looking for now is more guidance from Fed speeches now that are taking place, live speeches that are taking place in upcoming conferences. And then Thursday, again, not too much data points, but the unemployment rate in Australia, that came in a little bit better than the market forecast. It came in at 3.4% in comparison to 3.5%. And employment change had reduced though. That's sort of a, it's a double-edged sword, isn't it? So one, yes, you want lower unemployment rate, but at the same time, you want a lot more jobs available. It seems there was less employment change than anticipated at minus 40.9K. Then moving into the US session, it was the Philly Fed Manufacturing Index, which came in at 6.2. We had the unemployment claims at 250K. Yeah, mostly some low impact news. Again, note the FOMC member speech at that time as well. So there was a speech at that time. I'm going to cover that in a little while. And then we closed the week. The markets were pessimistic, but some of the data points wasn't so bad. Okay, so it seems, if you look at the Canadians' core retail sales, came in a little bit worse than anticipated, but the retail sales month-on-month figure came in at 1.1%. Okay, so some of the data points came in a little bit better. Even the retail sales, UK retail sales, even though we had a double-digit inflation figure being reported on Wednesday, but on Friday, the retail sales month-on-month figure is a little bit better than what was anticipated at 0.3%. It was expected to be in contraction of 0.2%. So some of the data points were not so bad. Some of them were quite bad, especially with the UK inflation reports coming into double digits. Just having a quick review, as we know that inflation is the key catalyst that's driving market conditions, and how central banks act upon this is going to be the most important point that you would want to view on an ongoing basis. Now, there's two elements to that. There is the Fed tools that they can apply, and that's not QE but QT, quantitative tightening, so reducing the balance sheet at the same time as raising interest rates. And what's been mostly focused on is raising interest rates by central banks. The more aggressive you are, the ahead you are of the curve, and trying to exacerbate the inflation figure and see a downtick in potentially, and that's what we saw with the most recent US inflation data, a downtick. But the question is that now have we reached the peak, or is that just a correction in the overall trend direction? Whereas the European inflation report is still moving to the upside. Okay, so that's the key. So one element of it is the Fed pause, but at the same time, what we want to, as traders, we don't want to wait for the decision and then react. We want to anticipate, right? We want to, that's the whole point. We're speculators. So we want to speculate what's likely to happen going forward. And that's where now reviewing Fed speeches is very important, because that's going to give us an indication of how hawkish, or have they twisted and maybe pivoted to a more dovish rhetoric, right? And that's what was actually came across in the last Fed interest rate meeting at the conference, the press conference thereafter, where Jay Powell came out and did have a dovish pivot, right? Where they're going to become more data dependent. They're going to be relying less on forward guidance. So those are sort of the key rhetoric that came through. But since then, that's not been the case. So since then, it's been the opposite. We've just had Fed members come out and say, no, inflation is still the focus, and we're going to continue to ramp up the interest rates until we see inflation back at normal levels, normal region levels, right? So, and I mentioned this in last week's session, guys. If you attended last week's weekly market analysis, that is what I focused on. That is what I mentioned, is that just give high regards to upcoming Fed speeches, because that's going to drive sentiment. And if that drives sentiment, you're going to see price react to it. And that's what we saw in Friday's session. So we had a number of weeks where we saw markets at these moving in the more bullish trend, more of a bullish trend. So I'm just going to have a quick look at some of the notes that I've made here. So what we saw as we came to Friday's session, I come back over to equity markets, and we're just looking at, you can look at S&P 500 there, we've got Nasdaq in this region over here. And if you just look at overall, so just the equity markets, even the German DAX, as well as the FTSE 100, Friday's close is what led to that turnaround, okay? So where we saw, you know, equity markets hit almost a 4-week winning streak, okay? 4-week winning streak. It snapped that winning streak, and we've printed losses, okay? So, and that is being largely, as I mentioned, driven by one key factor, right? It is the Federal Reserve policymakers. These policymakers are reiterating their commitment to tighter monetary policy stance, okay? And it doesn't matter if they feel that, okay, you know, inflation, the markets, you know, has a bit of a boost where they see that inflation might have peaked, but that's not enough for central bankers. That's what they're coming across and saying. We've got to stamp out inflation entirely. We've got to see a downtrend being formed. It's got to come back to levels where we're happy in that range. And that could be somewhere between the 2 and 5% range, where most central banks want their inflation levels at 2%. Yeah. And we're still sort of, you know, very far away from coming close to that 2% mark. So yes, the focus became around central bankers and their speeches. And that's what drove the sentiment now and the turnaround. The question is, are we in that bigger picture, you know, bigger picture view where we had a bull rally in a bear market? And it seems so. If I do a full screen view of the S&P 500, and look how great it is when you have both some of the fundamentals and the technicals working coincidentally, right? They work almost in line with each other. So we've had the bottom being put in around the $3,635 price level. Since that low has been put into place, we've had a bull trend occurring. So if I take a measurement from this low and I take it through to the most recent high we've achieved, so we've seen almost a 19% rally, okay, 19% bullish move occurring. But overall, if you look at the trend itself, we are still in a downtrend. The last rally, if we have a look at that, so from this low, I'll take it from the extreme low rather than those other sort of lows in this region here. I'll take it from the extreme low through to back up to those highs. That was a 30% move. Okay, so a 30% recovery before we had the next leg lower. Right? And if we look at some of the moves that we've seen to the downside, so the first move to the downside, we saw almost a 15% sell-off, and then we had a 13% recovery, and then from this high through to those lows, that was a 21.5% sell-off in the S&P 500. Okay, and then we've had an 18%, 19% correction. Now the question is, are we going to see the follow through to the downside now? Right, that's where we are now at this moment. But what I would be looking for, this is what I'll be looking for going forward. I'll mention some of the data points as well. But what I'm looking for is that continuation of rhetoric from policymakers, right? And especially this week's going to be an important week when it comes to policymakers as well, because we've got Jackson Hole. So, yeah, that's where the focus is going to be, right? So, we've seen the turnaround. We've seen the turnaround in equity markets. The question is that going to continue to move to the downside? What I'm looking to review, especially towards the end of the week, where we have Jackson Hole, which begins on Thursday, and we're going to have a keynote speech from Fed Chair Jerome Powell, which is scheduled for Friday. And the market's going to be anticipating just a continuation of that hawkish commentary regarding how they're looking to fight against inflation, and if there are other concerns that are impacting them as well. Yeah. Okay, so looking through into the wider economy. So the Nasdaq also in a similar price action, as you can imagine. Naturally, you're going to see more reactions occurring with the Nasdaq purely because of the association with technology stocks, right? So technology stocks are more likely to be hit on a risk-off sentiment. We're not quite in a risk-off sentiment or a panic, but what I will show you, and let me just bring that up now, is this. So the US recession probability has risen to just break through that previous high that we've had back in 2007, 2008. Okay, so we've got an elevated amount of recessionary fears being priced in at this current moment. It is around the 25% mark from this report here. Okay, so yes, we had a quick short recession that took place in 2020. Well, that was as Liz Truss continues to state, a 100-year pandemic that we've not seen, right? So every 100 years, you apparently have this pandemic. I'm not sure if that's always the case, but hey, that's the sort of the key point that she stresses a lot. But, that was short-lived, but then there's been sort of knock-on impacts from that, from the lockdowns and the amount of fiscal and monetary stimulus package that were offered. That's led to the concerns that we have at this current moment with inflation, lack of GDP growth at this current moment, which is potentially now pivoting towards a stagflationary period. The question is, how long is that going to last for? Now, the central banks that react first and get ahead of the curve, they're likely to have more of a soft landing. Soft landing basically means that they're able to not allow the economy to overrun and get overheated, right? And just cool it off a little bit, where they're able to, raise interest rates, bring down the sort of markets a little bit, but you're not causing a real recession. So an example of that is, obviously, we've seen that the US is in a technical recession because they've reported 2 quarters of negative GDP. But they've defined that, hey, this is not enough information for us to call it a real recession yet, because our labor market force is actually very good. It's very strong, right? So there is, some sort of views there in regards to the impact, that whether we are in a technical recession or a real recession, and the real recession is not being emerged yet. But generally, you would assume that a real recession is only going to be regarded once it's already happened, right? So, maybe in a year, 2 years from now, we might say that, yes, we was in a recession then, right? That's just sort of the key point there. Whether you believe in a recession or not, it's of your own opinion. But this is showing that it's not just a short, quick recession we're going to see, right? Like we saw with the 2020 pandemic. We might see a prolonged bear market, especially with the way the market conditions are. Supply chain issues are still sort of working in the background as well. Yeah. Okay, and then of course we've got the geopolitical tensions with what's taking place with Russia, Ukraine, and then in addition to that, then you've got Taiwan in regards to US and China as well. So this is a key factor here. But what I did see from last week, one of our members shared with us, is something like this, right? This is a great view. Well, it's a roadmap for how the economy responds to changes in rates. So it's not showing that all the impact's going to take place in one go. You're going to see almost like a follow through of, certain industries or certain sectors being impacted first before others go along to it, right? So it's like that spiral effect, right? So the knock-on domino effect is what we're looking to see in this case. So the earliest indicators to turn, right? So the earliest indicators to turn. I'm not going to go into the detail of sort of, what you're looking at anyway, but what I am going to focus on, the reaction, right? What reacts first, then reacts next, and then reacts last. That's the spiral effect. That's the domino effect we're likely to see in a bear market and in a recession. So the first is the housing market to slow down, right? Now, if you read any of the news overnight, we're already seeing a massive slowdown of house prices globally. It first started with China. A lot of the property developers got impacted, like Evergrande initially. We've just seen now two coincidental sort of weeks, back-to-back weeks of 2 Mondays. Today and last week, Monday, we saw the People Bank of China, so the central bank in China, reducing their lending rate, reducing the lending rate to spur on more borrowing, right, to boost the economy, because they're seeing already that slowdown, property developers slowdown really being impacted in the broader markets. At the same time, we've seen a drop in house prices in Australia and Canada. Now it's been impacted in the US, is beginning to have an impact in the UK. So house prices are beginning to come off. Certainly that's the sort of the key points there. If you look at the construction side of things, certainly they are being impacted because of higher prices in their energy or in the commodities that they're using. And they're also slowing down as well. So we're seeing the first to slow down is going to be housing. What happens thereafter, and the next to be impacted by that, is if there's a slowdown in the housing market, there's going to be less orders coming through, because construction companies are going to they're going to prepare themselves for the slowdown, right? They're not going to continue to put in the same orders as they once did. So they know that they're expecting less of a demand, so they're going to have less orders going through. So that reduction in new orders is going to be impacted in the broader market conditions, right? And if there's less orders going through of certain goods and materials that they need, right, then that's going to be impacting the companies that are selling these goods and services that they're offering, right? That's going to be impacting their bottom line, their profits. And if those profits are being impacted by them, then clearly what are they going to do next? And that's going to have an impact on employment, right? That's where you're going to see them, rescinding their tenders that they have at this current moment, reducing their labor force so that they can better manage in the conditions where they have less profits. That's the knock-on impact that we're likely to see. That's the domino effect that we're likely to see. So we are just in the first innings. We're just in the very first sort of, step of a potential longer-term bear market and potentially a very long-term recession. This is what was regarded by the Bank of England Governor Andrew Bailey in his last interest rate decision press conference. He stated, in 2023, we're likely to have a long, prolonged recessionary period. So this is the case, right? And just look at the time there as well. Look at the time there as well. There is that delay, the time delay there as well, okay? So you're looking up to sort of 24 months in total of this sort of having this knock-on impact going right to the end where it does have that labor force impact, okay? So that's why it may be very important for central banks at this current moment to raise rapidly now while the labor force is at a very good level, because then later on, when you get to that longer term and towards the end of that domino effect of a recession period and the impact of it, you can begin to reduce interest rates to spur on the economy a little bit, right? That's what you can do. So yes, that's sort of the sort of key factor there. So yeah, I wanted to share this with you because this really puts into your mind the bigger picture view and what to anticipate going forward as well. So coming back to the economic calendar, just to sort of quickly go through the central bank rates again. So Kiwi is at 3%, CAD, Canada is at 2.5%, the US is at 2.5%, Aussie 1.85%, UK at 1.75%, the euro is back up at 0.5%. Japan's staying with a loose monetary policy as they have done for many, many years. So the Swiss franc was at negative 0.75. It's now at 0.25. They had a surprise 50 basis point rate rise. Let's see if they go into the positive territory at some upcoming meeting. It's very unlikely. But yes, we're seeing the central bankers quickly get to those elevated, those highs of, interest rate levels. Yeah. Okay. So going through, maybe having a quick look. So yes, as I mentioned, looking at China. So overnight, they had cut their rates again. It's happened now 2 weeks in a row, as they're likely to support the economy and the struggling housing sector, right? But this has failed to provide anything more than a modest lift in sentiment as it did last week. So it just seems that the market are saying this isn't enough, right? Reducing by 0.1%, 0.2%, 0.25% is not enough for us to really see this as a positive thing to do to sort of support the economy. Yeah. At the same time, we've also seen the US dollar. Look at the US dollar where it is now, right? So if I just zoom in there, you can see where the US dollar is now. So the US dollar is printing a fresh 5-week high versus all major pairs, right? After the Fed officials, as I mentioned, they flagged the likelihood of a continued aggressive monetary tightening ahead, right? So as I mentioned, speeches were very important last week. That's where the focus was. We saw all these speeches come out very hawkish. What happens then? We see US yields rise. When US yields rise, we have the knock-on impact taking place in the dollar index. Okay, so that's where we see dollar strength coming through. And that's likely to continue as we go into Jackson Hole. But yes, you just got to be a little bit mindful of what takes place during Jackson Hole as well. Okay. Something else that I might share with you. Last week, there was some discussions in regards to meme stocks. It seems like some of these meme stocks are making a comeback. And I want to share this chart with you just so that you have a quick overview of what's happened so far up until this point. Let's put it into perspective, right? Let's have that sort of bigger picture view, right? So looking at sort of the 4 most popular meme stocks that were traded. So we're looking at GameStop, AMC, Bed Bath and Beyond, and BlackBerry. Okay, and it was last week we saw Bed Bath and Beyond show some signs of a meme stock drive, right? So a lot of price action, a lot of volume coming through. So some of these stocks still are quite elevated to where they were previously. That's the sort of key surprising factor there, apart from one, we say. But okay, so looking at GameStop had risen through to 1,844. It's sort of, you could say half that valuation at this current moment. At 805 is their current share price. Looking through, so this is showing the value of $100 invested in each stock. Actually, let's reiterate that. So if you put $100 in this stock, it went up to $1,844. It's now sitting still at $805. So you're still doing quite well there. Yeah, so you're almost 4x still if you'd invested $400. If you invested in AMC, that went up to $2,950, right? And now it's at $909. Going in, looking at where these two at the bottom there, they didn't fare so well. $100 would have made you $297 at the peak, and then it fell lower than that, but it's back up around 104 at this current moment. And similar with the BlackBerry, you'll be pretty much back to where you began at that point, where at one point it went up to 379. Now let me just reiterate this, right? Just be mindful of investing in meme stocks. Okay, so you've got to really have a fundamental and a technical reason to get into a trade. You must have a setup where it focuses on what's your reason for entry, how would you manage the trade, what's your exit rules on this as well, and you've got to stick with those types of rules, in my opinion, if you're trading on the very, very short term. Yeah, you can't buy and diamond hands, right? Holding to see what happens. I think always going with the plan. Most individuals that do that do end up losing their shirt as well. So that's one key point there. Second one is only invest what you can afford to lose as well. Yeah. So just take some of the disclaimers that are very important when it comes to investing and trading as well. But yeah, I just want to have a quick review of these meme stocks and where they are now before we hear more about these meme stocks. This almost pump and dump situation that we're seeing in these stocks. Okay, and just looking at some of the asset classes in regards to the formation of this current moment, right? So we're looking at asset classes by year-to-date total return. So commodities, as they have been for a number of months now, continue to be the most interesting of asset classes, and they've been outperforming for well over a good few years now. So commodities year-to-date is up 33.9%. Oil is still up, even though we've seen a larger correction taking place. But yeah, oil is still up 70.2%. Dollar index has definitely been the one that's been, really made the most gains we've seen year to date at 11.4%. Looking at gold is down at 3.7%, considering that you have these, the likelihood of a recession is gaining. You have still a lot of market concern, but none of that's been going priced into gold as of yet. But do note, gold is seen as a safe haven. And the point being is, I feel that the market is more about capital allocation, right? Understanding that you might be in a risk-off situation and knowing how to deploy your capital correctly, that you are making and generating an alpha. When we're not at that point yet where there's panic and fear in the markets, that's where gold will outperform, okay? Stocks are down 11.9%, so we've seen some recovery taking place. If you've just seen the most recent sort of July and August bounce that we've seen so far, high-yield corporate bonds is down, investment-grade corporate bonds, government bonds also down 14.6%. Bitcoin is still almost down 50% at this point. Yeah. Okay. And just having a look at some of the sort of other news that you should be aware of. Well, as I mentioned, energy is still a concern. Energy is still a concern. We've seen this being impacted in China also, a region where they're facing severe power outages. Yeah, so there continues to be this concern in regards to energy. Now, the daughter of Vladimir Putin's spiritual aide was killed over the weekend, and is this going to intensify the fight that we've seen that's taking place over the borders of Ukraine? So yeah, that's something else just to mention there. Workers at the UK's largest shipping container port walked off the job. So towards the end of last week, over the weekend, we had Transport for London and a number of strikes taking place in regards to that. So there's a lot of concern in regards to travel. And at the same time, I was seeing this also. And there is that discrepancy without a doubt. You've got to see it, right? Is the fact that, especially in the UK, we're seeing inflation at these 4-decade highs. So that's ramping up the prices of goods and services being offered. At the same time, you've got this cost of living crisis, where energy bills are also going through the roof. Gas bills are likely to go through the roof also. We're seeing that going to continue to rise in the upcoming months as well. Petrol prices are still at these elevated levels, even though we see petrol price, well, the price of barrels of oil will come down, but I'm not seeing that being conveyed when we look at your local petrol station in regards to what the cost is for an unleaded or diesel petrol oil. So yeah, petrol certainly is still a concern. That's being, and that's really dampening consumer sentiment. That's dampening consumer sentiment, and then clearly, wages have not grown in line with those prices, those elevated prices, especially now. So you're certainly going to have a large disgruntled group of individuals that are going to see and be striking and looking for higher pay. Now, we knew everything that took place in regards to Nancy Pelosi's visit to Taiwan, but at the same time, what's not been mass marketed, should we say, is last week we had 5 delegates from the US go over to Taiwan to have further discussions and develop some form of economic incentive for both countries, right? And now we've seen another US lawmaker head over to Taiwan also. And yeah, I mean, semiconductors is a big concern, and Taiwan has one of the largest corporations that provides semiconductors as well. So, how will China take this, right, is the key question at this moment here. Is this going to cause a little bit more disgruntled between the two countries and more concerns, right? So these are some of the sort of key notes to take away at this moment. The final point I did wanted to cover is this here. Now, in the Eurozone, there is that is where I see the highest risk to be in regards to a recession. At the same time, not just a recession, but a complete depression, right? Is what could potentially happen in the Euro region, the Euro bloc. And that's one of the big four economies is Germany ultimately, right? And you've got to see that Germany and France, in regards to their the electricity, has just gone through the roof. The forward price being viewed here, and then that's going to cause a grave amount of concern. That's certainly going to cause a grave amount of concern. Some of the sort of key points to take away from that is that what is Russia likely to do now? So we know that Russia is going to switch off one of its pipelines for 3 days in the upcoming month as well. So that's something likely to take place, and that's going to cause more concern. That's going to cause certainly more concern there. So just be mindful that the Eurozone is certainly going to have a lot of concerns in the weeks and months ahead, especially coming into the winter period as well. Yeah. Again, I'll provide more research in regards to this in a separate report. But yeah, just wanted to share that with you. Okay, fantastic. We've come to the end of this session, right? So we've covered some of the sort of most anticipated of news for the week ahead. Like I mentioned, the key factor is the Jackson Hole Symposium that's taking place at the end of this week. So again, you're going to follow what are the policymakers' views in regards to their interest rate decisions and upcoming meetings that are taking place. So we want obviously a continuation of hawkish stance and raising interest rates, or have they pivoted? That's sort of the key point there. Another key point to mention is we're going to have a key inflation report being released at the end of this week. We're going to have the PCE, so the Personal Consumption Expenditure Price Index for the month of July being printed. Now, the PCE price index measures changes in the prices of goods and services used for household consumption, and is the Federal Reserve's preferred inflation gauge. So it's highly regarded by the Fed themselves. Okay, so the PCE price index is projected to have moderated slightly in July, but again, that's what we've got to really focus on. So you've got to continue to focus on inflation reports. You've got to continue to focus on policymakers and their stance as a way of judging what our market conditions are likely to be in the upcoming weeks and months, and then make your trade decisions based on that. Naturally, you do want to look at the technicals thereafter to confirm your entry points and stop loss and take profit levels as well. Okay, fantastic. Thank you for joining in this session with me. Hopefully you got a lot from this. If you have any questions, please feel free to get in touch with hr@alphachain.co.uk. Thank you for joining the session. Take care. Bye-bye.